All right, we're going to start today by looking at the chart of the S&P 500. You can see that we have been overbought for about 4 months right now, and we're continuing to stay above the 20-day exponential moving average and the 150-day and the 200-day moving average, which is all signs of momentum. And we are basically hugging the 20-day exponential moving average. As long as we're above that moving average, we're going to keep going up. So let's look at the front page of Yahoo Finance. You can see, let me see, what's a good story? European airports hit by cyber attack on check-in provider. All right, so what do you get from that report? For stocks in general, cyber attack usually indicates that the cyber-related companies in America will have a blast of activity. Let's look at one of the biggest, not the biggest, but one of the biggest. This is Palo Alto Networks. You can see that this stock is in a trading range. Look at this. At the bottom of the range is 167. The top is 200 right now, where it's at. So these stocks are very volatile. You can see that it was in an uptrend, but it's basically in a sideways pattern for at least the past year and a half. Let's look at Palo Alto in general. Um, the PEG ratio is 1.86. That is pretty rich. That means it's almost two times, it's trading for two times its growth rate, meaning if its forward PE is 54, that means it must be growing at 30, um, around 30% a year, their earnings. That's hmm. So in general, the cybersecurity stocks are quite expensive and they're very volatile. So I guess, and they're very much needed in the world and they're indispensable. So whenever this kind of stock travels down to the bottom end of its range, that's when I would want to buy something like this. Um, we saw um, a lot of volatility in these stocks. You can see it's overbought in a major way. But we have this ceiling of a price right here that we can't seem to go above. So, um, I don't know. We'll watch that sector. But for me, cybersecurity stocks are pretty expensive. I like to buy stocks when they have a PEG ratio of one or um, around there. Let's look at some of our calendar. Okay, this week we had the Fed meeting, and we see let me see what time. September 24th. Okay, so we had the Fed meeting, reduced interest rates, and we had triple witching. So if we look at our front page of Yahoo Finance, you could see that we were very volatile on Friday. We went down initially, and then we went back up. That's just a sign of options. Whenever options expire and all together at the same time, a lot of times you have people buying large portions to cover their options liabilities. All right, so you can see the S&P was up 0.5%, NASDAQ up 0.75%. Right, let's look at some more of our talking points. There's not a whole lot of going on in September news-wise. The only thing that we have a couple unimportant earnings reports coming out, and that'll be basically a wrap for the earnings for this reporting season. October is traditionally a good month. That's why I have it green. Um, we have, let me see. Yeah, we don't have a whole lot of news coming out in the next couple of weeks. We do have end of quarter window dressing, meaning at the end of every quarter, the stocks that perform the best so far quarter to date will get bought because it's called window dressing whenever the money managers like mutual fund managers want to make their top 10 holdings look good. All right, so let's look at the earnings reports from this week. We had, we, we don't have a whole lot of reports. We had FedEx come out with earnings and Lennar. Lennar disappointed. So we had two things going against Lennar. Number one, interest rates this week have been going up, even though the Fed reduced the rates by a quarter point. As Lennar is a home builder, they benefit whenever the interest rates go down. Okay, let's look at the earnings that are going to be reported next week. There's not a whole lot. This is like straggling couple remaining. We have some home builders. We have KB Home. We have Micron. This is probably the most important one, Micron. That gives you an indication of how the AI story is going. And then we have Costco. Basically, Costco is trading for a PE of 50, and they're growing around 10%. So that's 5 times overvalued, but they're always trading at a 5 times um, a peg ratio of 5, which is pretty amazing. Um, we'll see what they say about the consumer on Friday. Other important reports coming out, maybe Jabil, they're a tech company. Um, and I think that's it. All right, so let's look at some of our numbers. S&P is up 1% for this week. Nasdaq's up 2%. Um, we still have some momentum in the stock market. Over 50% of the S&P is above their 50 and 200-day moving averages. This is interesting. The Fed reduced their interest rate, um, the federal funds rate by 0.25%, quarter percent, but the 10-year went up 2%. And you will see that that will hit all of the stocks that were hoping for a lower interest rate. The 2 year is unchanged. So it's very interesting. Let's look at our chart here. It's very interesting that the 10-year Treasury yield has gone up this week by 2%, and the stock market still went up. Usually there's an inverse correlation, but there's definitely an inverse correlation between interest rates going up and the housing sector, because as the interest rates go up, interest rate of the 10-year yield, the home builders go down. So that's why we're going to see some of the home builders and home related stocks go down this week. All right, so let's look at, okay, average stock market returns. Okay, so we've had a pretty positive month so far in September. These are seasonality. A lot of times they work, let's say over 60 or 70% of the time, September is a bad month. But this month happens to be a good month, so we'll see. It isn't over yet, but it's supposed to be more volatile also. So we haven't really seen that yet. The VIX has been really low. So this has been a quarter. I mean, this has been a month that's outside of the ordinary. So we'll see if that continues. Let's look at the S&P trend lines. You can see this is almost a perfect trend line drawn between the highs and the lows of the S&P. And you can see that um, right above, we're bouncing right above that 20-day exponential moving average, and that is almost the same as our trend line. So as the if we break this trend line, then then all bets are off, and then we might be in a different trend. But so far, we're in an uptrend, and the stock market probably will continue going up. Let's look at, yeah, this is very interesting. The 10-year yield has gone up this week, even though interest rates were um, lowered by a quarter point. That happened the last time the Fed reduced interest rates. What was it, a year ago? And when they reduced the rates, the yield went up. So I'm not sure why that correlation that happens. Doesn't make a whole lot of sense to me. Um, okay, we don't have a whole lot of change right now in a lot of the market, the variables in the stock market. Oil hasn't changed. Inflation hasn't changed. We have the dollar exactly the same as it was last week, and gold is up 1%. And the dollar index isn't going anywhere either. It's still in a downtrend. Let's look at the beer greed index. It's greed right now. So we have to have the correlation is we have to be cautious and take some profits off the table if everyone else is greedy. Um, AAII survey. It's amazing. Usually when the stock market's going up, we see bullish for the amateur investor. But right now they're still bearish for at least the past 6 weeks. So as as the amateur investor is bearish, the contrary to that is you have to start looking to buy something or don't sell. Okay, so we have the VIX at a true low. I mean, we have no fear in the market right now. This is like at a multi-year low. So there's not a lot of people in the stock market thinking that the stock market will go down. So we have probably right here is our emotional blueprint right now. We're at the top. We're at the greedy, delusional new paradigm. So everyone still believes in the AI story, and they're bidding up AI and quantum related stocks right now. So we have some fluff in the market. And there's a couple things that could get in the way of the stock market continuing to go up. One thing is tariffs. If there are unexpected tariffs that could hurt some of these companies, or possible invasion of Taiwan by China, or some correction for some overvalued stocks in the stock market. Okay, today we're going to go over Bill Nygren, his his mutual fund. He thinks that the stock market right now is pretty overvalued, and he likes to buy value-oriented stocks. So we're going to go over some of that would possibly perform a little better if there was a market correction. Let's look at the PE ratio for the S&P right now is around 25 according to Wall Street Journal. And you can see over time, this is one of the highest price to earnings ratios since the 1900s. So we've only been at this level of exuberance probably 5 times total, and that corresponds to um, some of the market crashes in that we've had in the stock market. But that doesn't mean that we can't continue to go up. And the stocks that are going up have earnings right now. So it seems like I'm continuing to hold my stocks. So Um, we'll see if it continues to go up. Sometimes whenever you're investing, some of the stocks that you own are overvalued. And then sometimes they're undervalued. And right now most stocks are overvalued. I like to point out some of the undervalued stocks just for the sake of practice. All right, so let's look at our worst at first. The best performing stocks last year were the communication services, the technology, and consumer discretionary. This year, consumer con communication services and IT are both the best performing sectors, with consumer discretionary being one of the worst. Some other good performing sectors are the utilities and industrials. Healthcare and energy continue to be the worst performing sectors. And it seems like that there's there are countless people saying we're going to go over some healthcare stocks later on today. Um, there's a lot of people saying that healthcare should be an outperforming sector. I mean, people were saying that last year and this year. Um, when will it start? I don't know. There's a lot of headwinds against the healthcare sector right now. Um, so we'll continue to watch that. All right, so let's look at S&P 500 sector PE valuations relative to history. Most S&P sectors are valued above their historical averages. This indicates optimism around earnings and macroeconomic stability, though it also heightens the risk of a pullback if growth falters. Okay, so this is just an indication. These sectors here are in the highest percentile compared to the 30 years. So IT and consumer discretionary are trading at 30 PE ratio. And energy, as a contrast, only trades for 15 PE, but it's not growing as fast. In healthcare, a lot of these sectors don't get a whole lot of respect. The one sector I do like is the financial sector. They only have a PE of around 17, but they're still growing um, around 10 to 20%. And they're one of the best performing sectors so far this year. All right, so let's look at the stocks going up and down the most today. Let's look at the sectors first. Change. Okay. First of all, when we look at our 10-year, we see that the yield is climbing this week. So it's up 2% this week. So we expect, let's look at our cheat sheet here. Yields of a 10-year going up. Okay. That's positive for large tech stocks, financial sector, insurance companies, and insurers. And it's bad for companies basically that need to borrow money. And are sensitive to interest rates. So that's small cap stocks, heavily indebted stocks, cost of refinance and borrow money goes up. So high yielding stocks will not do good because if you have a higher yield on the 10-year, then why would you want to risk putting your money into a high yield utility when you have a guaranteed yield? Also, home builders will be going down because the cost of mortgage payments go up, making housing demand go down. Speculative nonprofit companies. Okay, let's see if that happened today. Let's look at market movers. Okay, the ones doing the worst are oil companies, home construction. As interest rates go up, the cost of mortgage payments go down, so the demand for housing goes down. Why is oil going down? I don't know. Retail is going down. Another home building going down. Energy select. Hmm. Let's look at the price of oil to see if that's causing. Let's see. Hold on. Okay, crude oil isn't going down a whole lot, so that doesn't explain why oil stocks are going down. Real estate biotech. Okay, biotech companies have to borrow money. They are not profitable. So that's a good reason why biotech is down today. Real estate, we just talked about home construction, same thing. Telecom, they are high yielding sector. So they would go down because you have an alternative in the treasuries that's yielding higher. Okay, so high yielding would not do good. Stocks doing better today are gold miners and gold stocks. Okay, so maybe not sure why gold miners will be up to down today. I mean up today. Let's look at technology. Well, one reason why gold in general is going up is there's a large demand from central banks to buy gold as a form of replacing the U.S. dollar in their reserves. That's one big reason. And the second reason is um, it's a hedge against global uncertainty and inflation. So we have some inflation kind of in America, so people buy gold as a certain protection against the stock market going down or against prices continuing to go up for things. Let's look at what else is going up. All right. Well, that kind of made sense. And let's look at some of the market movers going up and down. Okay, Paramount, Skydance. They're right in the middle of consolidating and buying, I think Warner Brothers, Warner Media. They're consolidating and they're getting a lot of good press for that. We have AppLovin. AppLovin. They were added to the S&P 500. Actually, that is one of our on our stock screen for the past couple months. It's been in our top 10. So you can see it's like at a fair value right now, a peg ratio around 1, and it's supposedly growing at 80% and a lot of good numbers for this stock. We went over it a couple weeks ago. Um, so Newmont Mining, actually Newmont Mining has been on our screen for a long time also. They're a gold miner and look, they're maybe 5% undervalued right now. Their peg ratio of 0.95. And as gold has gone up, so has Newmont Mining. So the gold stocks are going up today, so is Newmont. And Oracle, Oracle is up because there was news on Friday about them being a part of the TikTok bid, and possibly maybe they're going to be housing some of the data for the TikTok acquisition. Um, Uber is up 4%. I don't know why. Fortinet, I think Fortinet is a cybersecurity company. So remember we looked at the front page of the Yahoo Finance and saw cyber problems with airlines in Europe. A lot of times, as soon as you see that story of cybersecurity breach, a lot of times these cybersecurity stocks run. And we have Apple. Apple, they released a new version of their phone, and there are lines. People actually may be upgrading now, finally. So that's a good sign for Apple, and they have been in an uptrend too. Robinhood, another stock that was added to the S&P 500, and it's continuing to go up. Let's look at the ones going down the most. We have some home builder stocks in here, a lot of home builder related stocks. We have Texas, we have Lennar, that's a home builder. We have Builders First Source, home builder. Stanley Black& Decker, tools for building homes. So as the interest rates went up a lot, that really hit the home builders big time. Um, what else can we see here? Okay, Micron. they're reporting their earnings next week. So some people are getting a little afraid of that. I guess what happened today with Micron is there were options expiring today. So maybe with their earnings coming up this coming week, people were kind of adjusting their portfolio, getting ready for that. All right, let's look at our talking points. Okay, let's look at Dan Now's picks from the beginning of the year. KBWB, that is the large bank ETF. It is up 22% this so far this year. That is his best pick. Cisco's up 15%, ADTN 12%. The worst pick so far is IJJ, the mid cap ETF. It's only up 4%. So it's drastically underperformed the rest of the market. All right, let's look at some stocks of interest. Okay, let's look at the home builder ETF. As you can see, we're in an uptrend here. We are totally oversold right now and at the bottom end of this range. Um, home builders should have, as we were in a rate reduction environment, we should have some positive momentum for the home builder industry in general. However, we have a little bit of unexpected movement. Usually when the Fed reduces for the past 50 years, I guess 90% of the time, whenever the Fed reduces the interest rate, the 10-year Treasury yield goes down. But for the past 2 years, that hasn't happened. So we have so that the home construction ETF is totally at the mercy of the 10-year Treasury yield, it seems. Okay, let's look at the next stock we have here. This is Altria. We have it totally oversold right now, and it's halfway between its trend lines. So um, I guess it's gone down in the past week or so because the interest rates of the 10-year have gone up. So remember we were saying the stocks that will do best and worst and if the interest rate of the 10-year goes up. This is an example. This is a high yielding stock, so it's going down. So I guess this is inverse correlation to the 10-year Treasury yield. Let's look at the next one. This is Boeing. You can see this is in a major uptrend from the lows of like $100 a share, $130 a share way back when in last November. You can see it's oversold right now and is at the oversold and at the bottom end of its range. It does have some support at this 100-day moving average. And they're getting a slew of orders from overseas right now. President Trump is visiting countries overseas, and there are some major deals, major orders for planes. And so Boeing's problem isn't that it can't sell planes. Its biggest problem is producing them and producing them without defects. So if they can continue they're actually making progress with that right now, and they're actually building more planes in a quality-like way. So if they can do that, then the stocks will continue to go up. So we'll see if this is like a turning point for the stock right now. So we'll see if it's oversold, if it continues to go up like that next. Next stock we're looking at. Oh, okay. This is something Dan Niles posted on his LinkedIn. He basically said, "Prudent irrational exuberance" was the title of his write-up. It basically says, with regards to the Magnificent Seven, he likes Google given the recent favorable antitrust remedies, their dominant position in consumer-facing AI, and valuation that is compelling at just market multiple. And he said they didn't have to sell their ad business, stop paying as the default engine on iPhones when the antitrust came out. So they did really good in this antitrust. They were trading at like a PE of 15, 17. Um, that was like half of what the stock market is trading at. And now what's happening is the stock is going up to what the other stocks in the Mag 7 are, the PEs. So Google has a PE of like 28 now. The They have an edge in development of AI. They can produce quality images and video content because um, Google has access to YouTube that has the largest amount of pre-generated video content to train on. And their valuation is compelling too. So he really likes Google. He also likes Amazon too. And he says, I believe that being positioned more broadly than in just Magnificent Seven is the best way to be positioned and to have prudent, irrational exuberance. So he thinks the other big AI stocks are kind of extended. All right. S&P has a 30 trailing PE back at the peak in 2000 and 31 trailing PE in 2021 and depressed COVID earnings. So, okay, he thinks that demand was pulled in. He thinks we're going to go down a little bit before Thanksgiving. We'll see what happens. Here's an article. Google's Gemini tops Apple's App Store, snagging the lead from ChatGPT. This was pretty big. Um, Everyone was afraid that Google would lose search, all the revenue from search to these new coming AI apps. And Google just took over as the top AI app in the App Store. So there's some momentum right now with Google, and it seems like it seems like every day we're getting a better piece of information regarding some of the some of the things that were holding it back. So almost every stock has warts, as you say. Warts are things that are bad about the company that they need to work on. And Google's problems right now are they have competition for search with AI. They have still some more government regulatory hoops they have to jump through. China is basically saying that they're monopoly and they have to change. There's a lot of but that list of things that people are worried about are getting smaller every day. All right. Here's a article I found. Oakmark's Bill Nygren. Here's what to look for beyond the Mag 7. This is to go with what Dan Niles said here in his last sentence. I believe that being positioned more broadly than just the Mag 7 is the best way to be positioned, and I have to have prudent, irrational exuberance. Okay, so we're going to look at Bill Nygren. He's returned he's returned about 13% for the past 10 years or more. And there's a YouTube video you should watch right here. You click on it, and he basically he thinks that the S&P 500 is like a tech fund. It's very dangerous, very dangerous. It's volatile. It's not a diversified collection of stocks anymore. There's only 10 stocks make up 30% of the index. And he thinks a more prudent approach is to buy stocks that are undervalued and hold them. His period of holding time is like 6 years or more. Um, so here are some of his theories here. He says bookmark fund is slow top line growth with return of capital to shareholder. He's a big believer in buybacks. So if a stock buys its stock back, that improves their earnings per share. A lot of the stocks that he owns are stocks that are buying their shares back. And he mentioned this stock here, which isn't in his top 10, Corebridge. They're buying back their stock at a rate where maybe in 5 years or 6 years, they'll buy all their stocks, all their shares back, and there'll be nothing left on the market. They might take out the entire company. So, so some of his theories are buy low PE stocks like with a PE of 13 or below, and that are growing a reasonable amount, and they're buying back their stock. So some of the stocks he highlighted in this video are Corebridge Financial. They do retirement services. There's a lot of competition for that. Delta Airlines, they're an airline company. Um, and Merck, they are a diversified pharmaceutical company. Let's look at some of its trailing returns versus the benchmarks. So you can see year to date, they're up 10%. That's around the S&P 500, a little bit lower. Um, 1 month, let me see, let's look at the 10-year, which is most important. They're up 13.36 for the past 10 years. That's better than the S&P 500, which is good. They were up 30% like last year. You can see like last year, they were up 30%. They were at 34% the year before that. Um, so this is just this is a different approach to investing where he's like a value investor. That's kind of what he is. So let's look at value investors. They haven't done as well as growth investors. So I'm just presenting to this as an alternative to um, buying the S&P 500 and growth stocks. And I highlighted some of the stocks that are interesting to me. I like to look at stocks. This this these are his top holdings in the Oakmark funds. The most important thing for me here are the forward PE, which is this column, and the PEG ratio. Let me see. Okay, I guess I didn't have that on there. Hold on for a second. I'm going to pull this up. Okay, this screen is a little bit shows a little bit better. Oh, here it is. Okay, I didn't. Okay, you can see this last column here, this PEG ratio. I was mostly looking at the stocks with the below one PEG ratio. Some of the ones that have a below one, that means they're undervalued, are Citigroup. We have Charles Schwab, Phillips 66, Capital One. We have AIG, Charter Communications, Ally Financial, and Merck, Dr. Pepper, and Fiserv. All right, so we've already been talking about Capital One and how they're turning into a Visa and MasterCard competitor. So he really likes this one. Jim Cramer likes Capital One also. And we've already gone through that a couple of times before, so we're not going to go over that one. Phillips 66, they're kind of a refiner and they sell gas. Um, I looked at their numbers. I couldn't really make a case for buying that one at all. Charles Schwab, they are, we were looking at this one like 2 or 3 months ago when they were down to five, no, probably 6 months ago when they were in the 50s. And this is one of his top holdings. So we're going to look at the fundamentals for this right later on. Alphabet, we cover like every week. And right now their PEG ratio is 1.7. So they're overvalued right now by like 70%. But it's really good to see some of the stocks that you hold or looking at in some of the smarter investors' portfolios. Okay, some of the other stocks are Ally Financial. They are one of the largest um, companies that give loans on cars. And Fiserv, they are a company that does um, that allows companies to take credit cards. Um, that's one of the things they do. And let's look at their financial company. So let's look at those companies just to see if there's any credence in what he's in his top 20. Other stocks that he holds are a lot of banks. He's an old bank analyst, so he knows a lot about banks. So that's why he has a good portion of banks. State Street. We see this State Street. We can see this is our stock screen for this week. And I highlighted some of the stocks in his portfolio that are in our stock screen. Also, we have Fiserv, we have Merck, Schwab, and State Street also is in our list of good stocks. So I thought it'd be interesting to look at some of those. Okay, let's look at Ally Financial. This is kind of one of the more dangerous ones because it involves lending to consumers. And right now, the interest rates are going down. So that's helping companies that allow people to borrow money from them. So you can see that Ally Financial, their growth is 20% from last year to this year, 48% from this year to next year, and then 12%. So I averaged that out to around 30%. Their PE is only 8, which is pretty amazing. Bill Nygren loves stocks with PEs, really low PE ratios. And their PEG ratio is 0.26, meaning they're 4 times undervalued. Um, but this stock has a lot of problems. So we'll go over the chart and everything later on, but you can see that its fundamentals from Yahoo Finance 0.44 PEG ratio. It's pretty low. I think it's half undervalued. Um, but a PE of 8 is one of the that's one of the lowest in the stock market. So let's look at some more numbers from this company. Profit margin is half of what we're looking for at 6. Return on equity is only 3. So that's like 4 times less than we're looking for. Their total cash, they have 5 billion in debt out of 11 billion. So that's half of their market cap. 1/3 of their market cap is in debt. So that's one of their, don't know, they have 10 billion in debt. So 10 billion in debt out of 13 billion, meaning most of their market cap is in debt. So that's pretty a large amount of money to borrow, but they're a financial company. Let's look at what CFRA says. They said it's a buy. They said their opinion reflects our view that Ally is gaining market share as the collapse of several regional banks in the spring of 23 led to steep competition pullback. So they expect the auto loan provider to gain pricing power and higher loan origin yields. With greater application volume from fewer competitors, Ally can decide which credit brackets to serve without cutting organizational volumes. Ally's net interest margin is set up to expand as short interest rates fall. So they're benefiting as interest rate environment goes down. This week, interest rates has gone up, so Ally should have gone down. So they're basically also correlated in a great way, inverse correlated to the yield of the 10-year. Let's see what their CFRA says about their fair value. They think they're overvalued by 6%. Okay, that's very close to fair value. One thing that's kind of troubling to me is their earnings. You can see that it's all over the place. It's not consistent. When I'm looking for a growth stock, I want to see 2, 3, 4, 5, 6. I want to see a straight line of 10% or more growth. This one, you see, one thing that's concerning to me about Ally is you can see um, it's like, well, it's inconsistent growth. That's my main point there. So, so we don't have like a really good indication that they're undervalued from CF per A. Let's look at what Morningstar said. They said the fair value estimate is 45, and that's right where it's trading right now. So they think it's pretty much fairly valued. It's not undervalued. They think challenging conditions, but the long-term position picture remains healthy. So they're the largest indirect auto lender in the U.S., with the firm acquiring auto loans from tens of thousands of auto dealerships. The bank also offers auto insurance, commercial lending, mortgage finance, credit cards through auto loans, though auto loans remain its core focus. Okay. And so this is like, it's interesting, but um, I'd have to watch it some more to really understand it. It's kind of a flaky company. Let's look at Fiserv. Um, Looking at their earnings estimates, they're basically growing around 17% from this year to next year. So if they're growing at 17%, their PE ratio is only 11. Their PEG ratio is 0.65, or half, almost half priced. And that kind of matches the PEG ratio of Yahoo Finance. And their profit margin is really good at 16. Return on equity is 12, which is just what we were looking for. And they have 1 billion in cash and 29 billion in debt. So they're 29 billion out of half of their market cap is cash, is debt, which is concerning, but they're a financial company and they're allowed to borrow money without, they're expected to borrow money. So let's look more at the chart of this stock. Okay, this is an example of a stock. It's like catching a falling knife. It seems like every month there is a news story that just drops it. And then just when you think it's making a little comeback, it drops and another drop. But these are drops of 10 or 20%. It's pretty major. You can see it's kind of baselining a little bit here, but the trend is definitely down. Um, and you can see it's oversold right now. This is a catch the falling knife stock. You got to really know what you're doing with this. It's a bank stock. They're lending money to people. It's a sketchy environment right now with the consumer. Okay, we'll follow this one, but this is a chart of death. This would have to break out and start an uptrend for me to be interested. What I would normally look for in a stock like this, you see this 20-day exponential moving average. It's been in a downtrend for like at least a half a year. If it starts moving up and then this stock just follows that moving average, that 20-day exponential moving average, and the rest of the moving averages kind of catch up and start going up. Then there's a baseline, I might look at it. But right now it's like the chart of death. So I'm going to stay away from that one right now. Okay, look at this. Here's another thing to look at whenever you have a stock that looks like it's falling and it's like a catching a falling knife right now. You can see I drew some lines in here of support levels. You can see this dotted line. These are prior highs, and that is a form of support right now. You can see that dotted line. So it has some support where it's at right now. If it drops again, another like 10%, it'll go down to this level right here, which was prior support going way back to October of 23. And you can see this July of 22 is another level of support. So falling knife, it could baseline here and then start going up, or it could continue to drop. We don't know when it's going to stop going down. There's no catalyst right now that I can see that can get it out of this mess. So let's look at, that was a good exercise. Let's ask Google's AI, why is Fiserv stock down so much? Fiserv stock is significantly declined due to concerns about slowing growth in its key Clover merchant service platform, missed growth expectations for its merchant solutions segment, exacerbated by a broader macroeconomic slowdown affecting consumer spending. Investors are reacting to disappointing quarterly results, including weaker than expected transaction growth and margins, and mounting investor lawsuits alleging the company misled about the Clover performance. Oh, man. So their biggest moneymaker in this company is Clover. It's like a solution that allows you to take credit cards for a company. They bought that from another company and they were integrating it, and it seems like it's slower growth than expected. And there's investor lawsuits. Wow, this is more problems that I want to deal with right now. Okay, but let's look at what CFRA says. They said it's a strong buy, and they said our fourth five-star rating reflects confidence in FI's ability to exceed financial objectives with double-digit organic revenue growth. We expect above average growth in merchant solutions due to its underestimated Clover point of service ecosystem as past investments bear fruit. FI has made strides in international expansion in Brazil, strategic partnerships strengthening position, including DoorDash integration, Affirm collaboration, expanding Walmart relationship, and new Klarma agreement across 100,000 merchant locations. Oh, wow. Okay, so they think they didn't give me a fair value calculation. So that adds to the sketchiness of this. If they can't give me what it's a fair value, it's really hard for me to really get a feeling for what this is worth. Let's look at its earnings over time. 1, 2, 2, 1, 1, 3, 4, 5. Okay, up until 2021, it's been really sketchy. It's not consistent. Now it's growing like 10% a year. Um, you can see they're getting a little bit more efficient over time with their return on equity. Let's look at what Morningstar says. They said the fair value estimate is 198. The price right now is 131. So that means they're 30% undervalued according to Morningstar. That is something. They had a merger with First Data in 2019. It kicked off a string of three similar deals that took place in short order. Over time, it's proven to be the most successful, with First Data moving from laggard to outperformer in their watch. Okay, so they've taken over a lot of companies, and that's why they have the debt that they do. So it might take them a while before they work off that debt and their um, maybe, however, the company worked on its leverage down to a more manageable level and growth improved, suggesting issues were not structural. Okay, so people aren't worried that they have problems with debt anymore. They're paying that off. Okay, so that's what Morningstar says. Um, they think they're undervalued. Okay, so we're gonna wait on that one to be more robust before I look into it. Okay, Schwab. This is probably one of the better ones that I looked at. Um, they're growing at around 25% if you average these out. Um, these are earnings projections for the next couple of years. They've grown at 25%. The PE ratio of only 17. That means they're 30% undervalued. Their profit margin is 3 times what we're looking for. Return on equity is 15. That's right what we're looking for. And they have more cash than debt. They have 30 billion in cash. which is this is a far superior stock than the other two we were looking at. Um, so let's look at what CFRA said. They said that they have a strong buy in the stock, target of 118. They say the strong buy rating reflects Schwab's healthy capital position and positioning to benefit from higher interest rates. Cash sorting slowed significantly, and we believe all significant cash sorting related headwinds are behind Schwab. Basically, what they're saying is people were moving their money out of Schwab's in order to get a better yield. And now they're not doing that anymore. There's not as much turnover. So we see this driving net interest margin expansion to 2.8% by year end with further upside. Um, Schwab is expanding offerings into alternative investments in cryptocurrency. So they're upselling their customers on different products after they get their money in their platform. Okay, so they think the fair value is 92.8, which is right around their fair value. They're overvalued by 1%. So they're basically fair valued where they're at right now. And if you look at their earnings per share over time, we see 2, 2, 2, 3, 2, another inconsistent earnings. They're not really truly a growth stock. I was kind of disappointed in that. Morningstar, as of May 12th, thought they were 13% undervalued. But right now, the stock is at their fair value. So they think it's fairly valued. They made this report a couple months ago. So diversified platform exhibits strength despite macro weakness. Shares cheap. Okay. So Schwab, they were concerned about Schwab having um, some underwater treasury positions. They had a lot of long-term positions in treasuries, and that's not a concern anymore, it seems, with the rate of interest rates going down. So, okay, that was an interesting um, that was an interesting delve into the Schwab company. It seems like they're undervalued. Let's look at the picture here. We have it's around 30% undervalued according to my calculations. So right now, the stock, I mean, everything is overbought in the stock market. I wouldn't touch this right now. I'd wait for the stock market to correct and before I would be interested in looking at this. Um, let's look at this other article from Isabel Net on Twitter. When the Fed funds, when the Fed cuts rates outside of recession, the U.S. stocks typically perform well, benefiting from easier borrowing conditions, stronger earnings prospects, and shifts in investor risk preferences. So basically, we're in an uptrend right now. Whenever the Fed cuts rates outside of a recession, the returns a year from now are like 90% of the time positive. I've seen charts like that. Um, so it seems like cutting interest rates really helps stocks go up. And let's look at some more there's some charts that are interesting. We noted whenever Apple right about here, whenever Apple stopped its downtrend, that we were in an uptrend for the stock. You can see that we're in a defined uptrend with it right in the middle between its trend lines. Apple is nearing like an oversold. It's like, it is 15. So that is near oversold condition. And it had a good news story this week with they had a new version of their iPhone that people are actually lining up to buy. People haven't lined up to buy an iPhone for like a couple of years now. So they're excited about the new version of the iPhone. So we have 2.3 billion iPhone users that could be in the refresh cycle. And they're actually getting better prices for their used iPhones. So that'll give people more of a reason to upgrade. Let's look at Pepsi. Pepsi is totally oversold right now. They're at the bottom of their range, and um, they're start they're starting to all of the moving averages are starting to turn up, meaning that it's starting to build some momentum. So keep an eye on this 20-day exponential moving average, this yellow line. And if Pepsi could continue to trade above that line and um, stay within these trend lines, the stock I think will continue to go up. We'll see. And Visa, you can see that Visa is oversold, a lot oversold, is at the bottom of its trend line, and a pretty decent time to buy that one. And let's look at another one. This is waste management. You can see it's in a multi-year sideways pattern. And we're at the bottom end of that range, and we're totally oversold. And if you're interested in a stock that will return like 8% plus a dividend of total return of 10% over per year for the next couple of years, um, this is a good one to look at. Let's look at T-Mobile. You can see it's oversold, really oversold, and it's near the bottom of its trend line. So we went over T-Mobile last week. T-Mobile, a lot of the telecoms are going down because the interest rates of the 10-year are going up. But T-Mobile doesn't really pay much of a dividend. It's more of a growth stock. Um, so this is kind of the perfect time to buy this or start dollar costing into this if you're interested in that kind of a stock. And we already looked at the screen for today. Here's the last thing I thought would be interesting to look at. This is David Tepper's runs a fund called Appaloosa Holdings. I thought it'd be interesting to go over some of his buys and sells since the last time he reported. The ones that he bought a lot of, he bought a lot of United Health. We've gone over that before. They're like a blue chip. They're actually the largest healthcare company in America. And Amazon, he's buying more. He bought more of that. He bought Nvidia up 483% from the last time he reported. Taiwan Semiconductor, so he believes in the AI story, and he bought Intel. Intel has gone up like 30% in the past week. Micron, he doubled its position, and they're reporting next week. They make memory for AI related servers. He also bought Block, Delta. Delta is one of the stocks on Bill Nygren's list of top 10 holdings. Whirlpool, Goodyear, and Mohawk Industries. Okay. The ones he reduced a lot of, he sold some of his Alibaba, Vistra Energy. Alibaba is the China tech company, very similar to Amazon in America. They're the Amazon of China. Vistra, they're very heavily involved in creation of electricity, um, AI infrastructure, energy, and Meta Platform, of course, AI related stock. They reduced 30%. Alphabet, he sold 25% of that position, and Uber, he sold 14%. So it's always good to check in on what really rich people that are running hedge funds are buying and selling. All right, I think that's all I had to say for today. All right, well, I hope you had a good week, and I hope your week is a very profitable one. I'll see you next time.